There used to be a reliable equation for the American dream. If you worked a 40-hour week or spent a lifetime paying into a pension, you could afford a life. Your income safely covered your basic necessities, with a little left over. Today, nearly 1 in 2 Americans live in a household that lacks the resources to economically thrive. The math no longer balances. This affordability squeeze does not discriminate. Professionals earning well over $100,000 in coastal cities are straining to pay their bills, right alongside seniors surviving on fixed incomes in rural towns. The ledger of household survival has broken. The expense column has grown so rapidly that it simply crushes the income side. Stagnating wages and soaring costs have turned basic budgeting into a zero-sum game. When the numbers don't add up, families are forced into brutal trade-offs. A mother has to choose between filling the gas tank to get to work or buying enough groceries for the week. An elderly patient has to decide whether to buy all of their medicine or just a fraction of it. For an increasing number of Americans, the ledger is reaching a point where the numbers simply refuse to balance. The heaviest and most unyielding line item in that modern ledger is shelter. In major American economic hubs, the cost of keeping a roof over your head has reached extreme levels. In Manhattan, median rent has crossed $5,000 a month. In California, the median home price sits at over $900,000. Middle-class professionals are scrambling just to make the mortgage. Families are literally sectioning off their own living spaces, renting bedrooms and bathrooms to tourists on the weekends to generate enough cash to stay afloat. For those who slip through the cracks, the alternative is unforgiving. California's streets alone hold a quarter of the nation's homeless population. The sheer cost of housing devours the bulk of a paycheck instantly. Before a family even turns on the lights or buys a gallon of milk, their financial buffer is completely gone. The next massive drain on the ledger is unavoidable risk. Climate volatility and health emergencies are compounding the financial strain in ways households cannot predict or prevent. States like Florida are hit by an average of nearly 7 separate billion-dollar weather disasters every single year. These back-to-back catastrophic events wipe out local economies and devastate regional housing infrastructure. That physical destruction translates directly into a financial shock. Insurance premiums for both healthcare and property are exploding. Small business owners are watching their medical plans jump from roughly $200 a month to over $3,000. Families are now gambling with their physical and financial survival. To afford daily life, homeowners are dropping wind, flood, and hurricane coverage, saving thousands of dollars a year but risking total ruin. Others with severe, life-threatening illnesses are forced to abandon medical care entirely because they have no safety net. Shifting the immense cost of catastrophic systemic risk onto individual citizens turns an unexpected disaster into guaranteed bankruptcy. Then there are the daily non-negotiables: food and fuel. These are costs that have structurally detached from the baseline rate of inflation. This chart tracks the cost of eating. It shows food at home prices climbing 32%. Working-class families in Pennsylvania are pooling their limited disability checks across multiple generations just to afford a single box of baby diapers. When basic nutrition and fuel become unattainable for a full-time worker, the economic logic of the working class has broken down. So how is the system still functioning at all? The affordability gap is being bridged artificially by toxic, high-interest consumer debt. This visualization illustrates a startling reality. 1 in 4 adults now relies on credit cards, buy now, pay later apps, or cash from payday loans just to check out at the grocery store. And this creates a brutal macroeconomic trap. To fight overall inflation, the central bank keeps interest rates high, but those elevated rates immediately punish the exact people relying on borrowed money to put food on the table. High-interest credit has transformed into a mandatory tax on basic survival. At the exact moment expenses are peaking, traditional government safety nets are fracturing. Tighter restrictions and reduced federal aid are pushing thousands of people off food assistance programs and closer to the brink. Non-government charities are buckling under the weight. Demand for food pantries has doubled, while their own donations are plummeting, because the people who used to donate are now the ones standing in line. Community leaders are calling for radical hospitality, a cultural shift towards sharing resources and keeping neighbors afloat. But charity alone cannot fix a broken economic formula. Eradicating this level of poverty requires structural, comprehensive policy changes, not just band-aids. Until the math of the American economy is rewritten, families remain trapped in an unwinnable daily choice between their immediate physical health and their long-term financial future.